Expense ratios are one of the most important factors to understand when investing in mutual funds and ETFs, yet they often go unnoticed by many investors. These seemingly small percentages can have a massive impact on your long-term wealth accumulation. In this video, you'll learn exactly what expense ratios are, how they affect your returns, and why choosing lower-cost funds can put thousands of extra dollars in your pocket over time. An expense ratio is the annual fee that mutual funds and ETFs charge to cover their operating costs. It's expressed as a percentage of your total investment in the fund. For example, if you invest $10,000 in a fund with a 0.5% expense ratio, you'll pay $50 per year in fees. These fees are automatically deducted from the fund's returns, so you never see them as a separate charge on your statement. This is why they're often called hidden costs. The expense ratio is calculated by dividing the fund's total operating costs by its total assets under management. If a fund has $100 million in assets and $500,000 in annual costs, the expense ratio would be 0.5%. You'll typically see expense ratios expressed as decimals like 0.5% or 0.05%. The lower this number, the less you're paying in fees, and the more money stays invested and working for you. Expense ratios cover three main categories of fund expenses. First, management fees pay the portfolio managers who make investment decisions for actively managed funds. Second, administrative costs include things like customer service, record keeping, and legal expenses. Third, operating expenses cover day-to-day costs like marketing, distribution, and compliance. All of these costs are bundled together into one simple percentage that gets deducted from your returns each year. Expense ratios vary widely depending on the type of fund. Low-cost options like index funds and ETFs typically charge between 0.05% and 0.2%. These funds simply track a market index and require minimal management. On the other hand, actively managed funds where professionals try to beat the market usually charge between 0.5% and 2% or even higher. The key question is whether the higher fees of active management actually deliver better returns, and research shows that most don't. Let's look at a concrete example using Python code to illustrate the impact. Imagine you invest $10,000 with an expected annual market return of 7%. With a low expense ratio of 0.05%, your net return is 6.95% per year. With a high expense ratio of 1%, your net return drops to 6% per year. Over 30 years, this difference compounds dramatically. The calculation shows the exponential growth formula applied to both scenarios. After 30 years, the difference is staggering. With the low 0.05% expense ratio, your $10,000 investment grows to $75,836. But with the 1% expense ratio, it only grows to $57,435. That's a difference of $18,401. You keep over $18,000 more simply by choosing the lower-cost fund. This demonstrates how small percentage differences compound into massive real-world dollar amounts over time. Here are the three most important things to remember about expense ratios. First, always look for funds with expense ratios below 0.2%. Index funds and ETFs make this easy. Second, understand that lower fees mean more of your money stays invested and compounds over time. Third, remember that small differences in expense ratios compound to produce huge savings over decades. Paying attention to expense ratios is one of the simplest and most effective ways to boost your investment returns. Every dollar you save in fees is a dollar that works for you instead of the fund company.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.